Hi everyone. Today morning, the Finance Minister Nirmala Sitharaman presented the Union Budget for the year 2021-22. This was one of the most anticipated budgets in recent times, with many of us keen to understand how the government plans to repair, restore and rebuild India's finances, which had faced much disruption caused by the coronavirus pandemic. From a common man perspective, there was an expectation that there would be some sort of a COVID cess or wealth tax or some provision that will transfer wealth from the individual's pockets to the government's coffers. In a major relief to all, unlike previous budgets, there were no major changes in tax this year. Instead, what we got was a budget built around health, hope and growth. We got a truly rounded budget which did no harm to anyone and ensured that almost all major sectors of the economy had something good to take home. Having said this, let's examine some of the major announcements made in this budget with commentary on how these might impact different stakeholders. The big mover in this budget was health, with the Finance Minister allocating 2,83,000 crores to the healthcare and wellness sector. This was an increase of 137% over last year, and the money will be used to set up almost 30,000 rural and urban health and wellness centers. Of these 2.83 lakh crores, a little over 35,000 crores has been allocated for the COVID-19 vaccine by the Finance Minister, with a commitment of providing additional funds if required. In fact, we did some quick back of the envelope calculations. Let's assume the cost per dose comes to 200 rupees. At 35,000 crores, the allocated amount takes care of 175 crore doses or 1.25 doses per citizen. The Finance Minister reinforced the government's commitment towards building an Atmanirbhar Bharat. This comes in the form of an expansionary budget aimed at boosting capital expenditure, increasing spending and providing greater employment opportunities. Infrastructure was a primary area of focus as the government looked inwards by putting forward many proposals in the budget. These included offering ports on a public-private partnership basis, furthering the tasks under the National Infrastructure Pipeline, raising the share of public transport outlay and deploying Metrolite technologies in Tier 2 cities. And as has been the case in previous budgets, this budget too has allocated big money, over 1 lakh crores, to build 11,000 kilometers of the National Highway Corridor. The Finance Minister mentioned some proposed highway projects in the states of Tamil Nadu, Kerala, West Bengal and Assam in her speech. We do hope the upcoming state elections in the next 2 to 3 months had nothing to do why these projects were highlighted. Moving to manufacturing, the Finance Minister laid out proposals for the creation of 7 mega textile parks over 3 years. This was in addition to the government's Production Linked Incentive Scheme or PLI for large-scale electronic manufacturing, which aims to make India a global hub for manufacturing and exports. Net-net, the government's capital expenditure for FY22 is quite generous at 5.54 lakh crores, which is a good 35% higher than last year. Finally, from an investment perspective, we found 3 interesting points in the budget. 1. The increase of FDI from the current 49% to 74% in insurance companies with some safeguards is promising, as it will help grow the sector. Plus, it will also showcase to global investors that India is open for business and is keen on inviting foreign participation in more sectors. Secondly, a public sector bank recapitalization of 20,000 crores has been proposed for FY22. While this is good, in our opinion, this seems a little inadequate and we think a lot more will be required to shore up the balance sheets of the public sector banks. And finally, the Finance Minister also said in a speech that a bill will be introduced to set up a development finance institution. The idea behind a DFI is not new and has been tried earlier. Unfortunately, previous attempts have not resulted as one might have hoped, but if the government manages to get this one running, then it will be a boon to all those 30,000 to 50,000 crore projects which struggle for financing. There is no doubt here that a professionally managed DFI is important for infrastructure financing. With the proposed bill targeting a lending portfolio of 5 lakh crores in 3 years, a well-run DFI will go a long way in boosting infrastructure. Now that we've talked about what the government plans to do to boost the economy, we should turn our attention to how the government plans to get there. On a macro level, the country's fiscal deficit is estimated at 9.5% of the GDP for FY21. That's the period between April 2020 and March 2021. This high number is understandable in a year when the revenues have been down and the government had to spend massively to just keep things from going out of hand. For FY22, the Finance Minister estimates a fiscal deficit of 6.8%, with a projection of steadily reducing it to below 4.5% by the year 2025-26. Now, to bridge this fiscal deficit gap, that is the difference between the revenue and the expenditure, the government is looking at two avenues. One, a borrowing of 12 lakh crores, which was a bit of a surprise and a pleasant one because this number was pretty much like the last year. The second and the more purposeful approach that the government plans to take to shore up its revenue is the monetization of assets with the proposed strategic divestment of 2 public sector banks and 1 general insurance company. The divestment of 2 public sector banks is quite significant because nothing of this sort had happened since the nationalization of the banks decades back. So this is certainly something new. In addition to this, the government will be looking forward to the fruition of other initiatives which were put into motion in the last 12 months, which includes the initial public offering or IPO of the LIC of India, the sale of Air India and BPCL, and the sales of non-core assets like surplus land via a special purpose vehicle. All put together, the government has a divestment target of 1,75,000 crores for FY22. In fact, the Finance Minister also mentioned in a speech that the Niti Aayog is working on the next list of PSU companies that could be taken up for divestment. So this doesn't seem to be a one-off and probably something that the government will continue to do. The budget showed remarkable continuity with its tax code, which was a breath of fresh air as compared to previous budgets. If you recall, the recent budgets of yesteryears had introduced major tax changes, including a completely new tax regime, long-term capital gain taxes, tax treatment of dividends, and more. The public at large and the stock markets have taken well to this, as most were expecting some kind of a cess or wealth tax to fund the government's post-pandemic program. Presently, this budget has made small tweaks aimed at improving the tax reforms which were undertaken a few years back. The focus has been on making taxes a less harrowing and harassing experience for all. Some provisions in that direction include the extension of the Vivad Se Vishwas scheme until 28th of February of this year, the reduction in tax assessment reopening from 6 to 3 years, reducing litigation for small taxpayers, and increasing the limits for tax audits from 5 crores to 10 crores. Further, in a relief to senior citizens aged 75 years and over who have only pension and interest income, the budget has waived off their income tax returns filing requirement. Some relaxations have also been provided to NRIs in terms of removing double taxation hardships, and in the same thread, foreign investors too will benefit from a lower treaty rate. With regards to affordable housing, the budget has extended the tax holiday on affordable housing projects until 31st of March 2022. Additionally, the government has extended the additional interest deduction of up to 1.5 lakhs on loans taken for affordable housing by 1 more year. Further, if you're someone like me who wonders how much capital gain needs to be paid or to which bank account the dividend is getting deposited into, there is a big relief coming your way. Going forward, details of your capital gains, dividend income and interest income will be pre-filled in the income tax returns, making life a wee bit easier for you. One final word on taxes. We did find one provision in the fine print that is applicable on taxpayers who invest more than 2.5 lakhs per annum in the Employee Provident Fund or in ULIPs, that's the Unit Linked Insurance Policy. The provision is indicating that there will be some taxation on maturity of these scenarios where the invested amount is over 2.5 lakhs. The interpretation of different experts is varying for now, so we'll do a little more research on this and do a follow-up video once we get further information. It won't be wrong to say that the current financial year has seen a number of mini budgets and not just one big budget. In fact, the total estimate of all relief measures announced by the government and the Reserve Bank of India in this financial year already totals over 27 lakh crores, which is 13% of the Indian GDP. From an investing perspective, the stock markets have taken very well to this budget. The Nifty has closed over 14,200 points today, which is a 4.7% jump over the last trading session. And this makes perfect sense. After all, the supporting pillars are all there to usher us towards a sustained 7 to 7.5% GDP growth. There is a visible infrastructure and manufacturing policy that showcases the government's willingness to spend. This itself is likely to set the pace for a big capital expenditure cycle, something that we have not seen in the last 8 to 9 years. B, there is continuity in the taxation policies, and whatever little tinkering that has been done has been with the rate of the customs duty, which will further boost production. And finally, an environment of low interest rate and friendly policies will go a long way in attracting foreign and domestic private capital expenditure. The sooner this cycle starts, the faster will be our country's growth. Overall, we found the budget having mass appeal and was created with much care to get the country back on track. However, how much of this translates to earnings growth and whether it will continue to support the current stock market levels is a question that is still a couple of quarters away from being answered. But so far, so good. I hope you liked our video and will draw many learnings from the data and the insights presented. Don't forget to subscribe, like, comment and share this video with your friends and colleagues. Thank you for watching, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents